A very good evening to all the members who have enrolled for this session. Myself, CA Rekha Umashik, a Regional Council member, SIRC. I take immense pleasure in inviting you all for this session on how to decode private equity investment in India and what are the opportunities for CA. So especially in the post-pandemic times, we have seen a lot of startups and a lot of new companies coming into picture. So what is the procedure or how do we go about investing in the top unlisted companies? What is the market that we have? What are the opportunities for the CAs in this regard? I think we have a speaker for us today who is exclusively into this particular domain. So I take immense pleasure and honor in inviting Aditya Guha sir. He's a chartered accountant, a diploma in information system audits, and also has a certified fraud and forensic auditor. So to tell more about Sir has over a decade of experience. He is also the vice president in StarCap Corporate Advisors in LLP. It's basically a mid-sized boutique investment banking firm which is based out in Hyderabad. Sir also has a expertise in investment banking, enterprise risk management, development of policies, standard operating procedures, SOPs, manuals, due diligence and valuation. And he has also performed various assignments with respect to process improvements, revenue assurance, and specific management reviews. He has also been a team lead as well as a team manager in various projects and has a diverse industry and service sector experience. So I take this opportunity to invite you, sir. The session is all yours now.
Yeah, thank you. Thank you so much, madam. And a very good evening to all the participants. And so today I will be basically taking you all through the topic is decoding the private equity investments in India. I think I've shared my screen for this. Is my screen visible?
Yes, sir, visible. Slideshow. Yeah, visible. Sir.
Yeah, perfect. So yeah, so today's topic, as you see, decoding the private equity investments in India and professional opportunities. So there are two parts of it. First part is basically I'm going to try to explain you what, I mean, we all know what a private equity is and what is a mergers acquisitions, what is venture capital, what's a startup, because that's the buzz term these days. And we know, and I just basically, as we are all representing the ICAI and also specifically today from the forum of SIRC, I mean, I'll be sharing some facts of how the companies down south is basically having a lot of traction with respect to such PE investments in India. So my slide, I just basically divided into few parts. First part will be basically the numbers and how the numbers of FDIs, what is the number of startups, what is the number of PE investments happening in our country, so that it gives us a basic knowledge with respect to what it's happening, because I'm sure most of the professionals here are from the background of audit, assurance, taxation, and of course you might be auditing, might be many startups, you might be auditing many companies which there is a PE coming in, or of course giving them the tax structuring part, but there where you are expertise in it, which I am not. So what I am into is basically how do we basically kind of support our organizations or our clients with respect to PE. So when you know when do we understand whether one of our clients, because it is more about giving a additional benefit to our clients. How can we be a differentiator amongst our peers? So yes, so that's what is my objective of today's session. I'm going to take you through slide by slide. Yeah, so this entire presentation will be into the 6 parts. First is introduction to PE, VC and M&A. Then how is India on a global investment radar? Private equity demystified. What are the fundamentals of PE? Some case studies. Of course, these are all market case studies. You are all aware of it, but still it will be a brush up for all of us. Ready, set, go is basically getting our company or our client's investment ready. So that's why I was talking about how we differentiate from other chartered accountants, or how we differentiate from our peers is basically advising our client whether we know that if our client is a small scale, because all the small or medium practitioners who are tax practitioners, auditors, so basically they will be auditing certain companies which are saying the turnover is between 20 to 50 CR. So these are the companies which, because all these PE, VC guys look into the mid-size companies these days, because of course once the company is matured, there is an IPO happening and all, which are the bigger games. But at least the clientele which are small or whose turnover is say between 50 to 20 to 50 CR. This is the sweet spot. Excuse me, I'm just down with a bit of cold, so just excuse me if I cough a bit. So yes, so the sweet spot of any clients for whose turnover is say between 20 to 50 CR is basically the target for all this private equity and venture capital guys. And more than the revenue, it is basically the idea and the concept, what they are into. So we're going to go through that as well. And the NEEF framework. NEEF framework is something which we do, where we nurture and enhance enterprise value. This is what we do as that's our professional service. But I also want to get you make all of you understand what is that NEEF framework all about. So there's a very funny quote which I was going through, and everyone is doing a startup today. I mean, we know that's the buzz, but especially once you land in Bangalore and in Koramangala area or anywhere, we know it's like, what are you up to? So this is a famous quote where I found it's I am starting a startup that helps other startups start up. So everyone, I mean, you see a Zepto, you see we know like we download, it's all app based these days, and IT services are one of the top private equity funded sector basically. Let's say this today only in the newspaper I saw Dunzo giving a 19-minute grocery delivery. I mean, what the sec? I mean, 19 minutes of Dunzo, 10 minutes of Zepto. So these are all this basically cliche marketing gimmicks, where of course the money is burnt by the private equity guys. It's not the promoters' money at the end of the day. But yes, there are certain, I mean, there should be a sanity with respect to spending the amount. So starting with it, let me just make you all understand what is the difference between a private equity and a venture capital. So private equity is basically nothing. It's a investment in or an acquisition in a stable firm. Let's say there is a firm or a client of ours whose turnover is say more than 5 CR or 10 CR, probably in the industry for past 5-6 years. Basically, so he started this company with their own fund, promoters, and it is successful. It is proven fact that the company is doing very well. So in this company, these are the sweet spot for all the PE guys. Okay, so these are the sweet spot for all the. Am I audible, please? Some issue with the.
You're audible. You're audible.
Yeah. No. Sorry, got some disturbance. So perfect. So yeah. So with private equity, as is a sweet spot because the investment or the acquisition is of a stable firm using a combination of debt and equity. I mean, you know what are the instruments? It can be a preference shares or it can be a convertible debentures. Those are the different combinations. But PE basically looks for some stable and well-performing companies from diversified industries. Their investment size basically be a bit large. It basically starts from somewhere between 5 million USD to 1 billion USD dollars. So there'll be a lot of million and billion used because that's a terminology which we use in this sector, where I also used to take some time to convert it into INR and crores. That's how we are trained. But yes, so the structure of investment in the private equity is usually a combination of debt and equity, and the ownership is basically controlled investment. So someone will not basically come into as a minority stakeholders in private equity. Private equity usually comes in with a typically greater than 50%, or basically having the controlling power. Vis-a-vis, if you see the venture capital, they basically venture, as you know, adventure. That's how the term venture has come. So adventure means risk. So a company or a fund house which has a high appetite, or there'll be some specific companies which into venture capital. So these are the companies who would be basically into higher growth potential. So all the startups where the idea is kind of which clicks with the venture capitalists or venture fund houses, these are the such fund. That's what they push in the capital as a form of venture capital. Type of companies, early stage companies that have a very high growth potential. And if you see the size of the investment will be of the smaller rounds, it will be basically 1 million to a $10 million. Structure will be usually debt or a convertible debt to equity. That's what it happens. And it's not a, basically they don't look out for a controlling stake. They look for a minority investment because it's still a startup. So if you ask me initially, you will look a company in the early stage will look for a venture capital, and probably once the early stage is over and when they're maturing, they will look for a private equity. Yeah. So this is one basically kind of a graffiti I got, where what they are trying to understand is basically, have you ever considered merger? So we all know mergers and acquisitions and we read a lot about it. But what is this picture is saying that if someone is lost and someone is found, can there be a merger be done? So what is mergers and acquisitions? Again, we all know what it means. Like M&A refers to a transaction between two companies combining in some form. What are mergers? Mergers is basically two companies of a similar size combining to form an entity. So I mean, there can be so many examples. I think the best is Z and Sony networks. I mean, both of them combined. Recently, I think the recent news, PVR and Inox, those grand movie houses, they had merged. So it basically, the purpose is to decrease the competition and increase the operational efficiency, because you get the volume discounts, you get the you can negotiate with the suppliers, the competition gets cut, and basically the business is more or less the same. It won't be kind of a like PVR and Inox kind of do the same thing. So mergers are basically two companies operating in a similar field. And how does an acquisition works? Acquisition is basically one entity purchasing the business of the another entity. It is basically the large shark eating the smaller fishes to be the big shark in the ocean. And the size of the acquiring company is bigger than the acquired company. So the acquiring company is basically the big daddy. So as we know, Byju's is that big company who's kind of now eating the small players like Grade and few other. So this is the hence difference between a mergers and an acquisitions. And India has seen, specifically south and western part of our country, has seen a lot of mergers and acquisitions happening. Every other day we kind of read in the news how this so many transactions happening. So what is the entire rationale behind it? Why it is happening? So it is basically nothing but, as we have discussed, it is to basically decrease the competition. And whose balance sheet is rich with the cash flows, positive cash flows, they have the guts or they have the appetite to kind of take over the smaller players. So because of the smaller players, I think as we know that Microsoft in the US kind of their acquisition, they acquire left, right, and center. Google does it because they kind of eat up the small players because the other day they should not become a competition to them. So that's the whole objective of kind of acquiring these other smaller companies. So this slide now, I'm going as we now with this 15 minutes, I think I have given you a good brush up with respect to what does a venture capital does, what does a private equity does, and what is the merger and what is acquisitions. So my entire discussion for next an hour around would be basically playing around in these two topics: the mergers, acquisitions, PE, and venture capital. Now let's see, where is India on the global investment radar, because there are a lot of FDIs and all happening these days. You see Uber, you name so many other companies, like foreign companies are kind of coming into the India. So why? Let us just run through the numbers quickly, like what's happening. So India has become an emerging magnet for global capital. So there's a lot of funds basically flowing into the India. It's a kind of a small chart which my team has kind of collaborated. If you see the FDI growth between FY12 and FY 2021. 2021 numbers are still provisional. There is a 2.41x kind of growth with respect to the FDIs, and 58% of the registered foreign companies are business services. So it is basically all the foreign companies which are registered in India are into the business services and more into the service sector. And globally, India is the 5th highest FDI inflows in the country. So it's a pretty good news for us, because it's so much of FDI inflows. It's kind of gives an Indian an emerging market for all the global players. So if you see in this part, the top 5 sectors under FDI inflows are basically service sector being 16%, computer software hardware telecommunications, trading, and automobile industry. So all your apps, you say WhatsApp, it's all in the service sector part, computer, software, and hardware. So these two only kind of comprising of 30% of the FDI inflows in India. And let me tell you, the service sector's computer software part is mostly from the southern part of the country. So I'll come to that as well. So despite pandemic, because I think me being in this market for a while, I think during the pandemic, we thought everything will slow down. But trust me, the deals which has happened during pandemic and post pandemic is highest. If you see the chart on the right side of your screen, the deal activity in India. So totally, there have been around, the deals with respect to the numbers are pretty huge. So the total value of deals which has happened is basically $114.9 billion. The private equity deals have been 66.1 billion, MNA 48.9, and venture capital 31.4. So that's the traction which Indian market is basically having. So see the number of volumes. So volumes is there. Basically there were 1286 deals in 2020 and 2064 deals in 21. So this is the pandemic year or post-pandemic 2021. So the maximum number of traction has happened during this part or post-pandemic. Probably the reason is people had some time to go through the numbers, because in the regular activities, because I'll tell you the background and how it works is that every consultants like us or every company sends that information memorandum, sends their FM to these private equity houses, and these PE companies have they are so busy. So I think every day they kind of go through 20 such dockets, and out of 20 they pick up first 2 or 3 for the next round of meeting. So for them they have to go through each and every docket and whether that investment, whether the pitch is good enough or not, then they kind of shortlist. So probably few of my colleagues who are working in PE sector, they were telling that like they're as, and you know, in the regular day to day, you come to office, your kind of productive hours get reduced. So apparently the productivity of these guys have increased when they were working from home, and where they could actually go through so much of deals, and there was so much cash also available in the market, they could utilize it. So despite pandemic, the deal values have retained its momentum. So let me just give you an overview on the private equity investments. So PE, there has been a 44% increase in the volume of transactions. So if you see in 2020, it was 42.4 deals. Now in 2021, the number of deals, which is the 42.4 is the value of the deals, $42.4 billion and $64.9 billion in 2021. And the number of deals is 2,000 deals, 2,000 plus deals in 2021, where there was a 53% increase in the deal value, 43% in the volume, and 66% of the PE investments are done in the growth and later stage companies. So this is very important. So if you see PE investment by stage, this particular chart on the bottom right of your screen. So the growth, if you see the in the growth, see the companies are into growth, early, late, buyout, and pipe. So in the growth stage companies, the PE has been investing, because that's how your returns will be very high. And IT sector dominated this year in terms of both deals value and also in volumes. So the key investments deals, so certain on the right side of the screen, there are certain big key PE deals which has happened in 2021. Like Flipkart is there, Hexaware. I hope you guys all know what is bundle technologies. Can I get some answers? It's an app I think we all use mostly every day. $1,250 million in venture capital, Bundle Technologies Private Limited. So this is a very common app thing which we all use, and that's the name of the private limited company. I think if I tell you the name of the brand, everyone has it in our phone. So that's basically Swiggy. So Swiggy is the name of the brand, but the company name is Bundle Technologies. And if you see the chart, the consumer, so the utilities, material, financials, industries, consumer staples, healthcare, consumer discretionary and information technology, IT, giving the highest return. What are the highest investments in the PE part? Now, I'm giving you a regional analysis. This is very much necessary because to understand where is the deal happening. So on the left hand side, if you see, I've highlighted Karnataka, Tamil Nadu, and Maharashtra. And in 21, I have added Telangana as well. So, and also a small patch here in the Delhi NCR region. So these are the various cities in which the maximum deals have been happening. So it can be an eye opener for all of us because there is so much of work, or rather with respect to activities happening where of course everyone needs a valuation, everyone needs an FM model to be done, everyone needs an information memorandum to be done, everyone needs an accountant, everyone needs a CA. So I mean, if you see the number of deals happened in Chennai was 44 deals, valuing to 501 into 2020. Pune had 53 deals, Mumbai 258, of course, being the Mumbai being the financial capital. But I think the winner goes straight away to Bangalore. So it's if you all know that it's called the city of startups. So it has 388 deals in 2020 and around 500 plus deals in 2021. So I mean the number of startups we have there, and of course all the ideas being coming from that part of the region. People settle up there because of good workforce. There are many other reasons they set up their startup there because of the quality of people we get there, and of course the beautiful weather that helps. So yes, so this is the. I just want to understand that this is a very good opportunity for all of us to cash it, because if you see the number of deals which is happening down south, I mean out of 4-5 states, even Kerala, even Andhra are getting their deals. Probably they're not in this deal charts numbers, but there are traction in that market as well. So what is PE exit? Now let's say if someone, a private equity guy, has kind of invested in your company, see, they will just come as a pure investor and they will sit on the promoter's head. They don't understand business, but what they have is the money. And they invest in your company basically, of course, to get a better exit. And there are so many PE guys who are still sticking on to the company because they're not getting a proper valuation of the stock. We know what happened in the post IPO of Zomato. LIC got again listed in a trading in a lower. No, they didn't start trading in a premium. So we know where the PE guys get stuck. So if you see, PE exits have been pretty good, and it has been shot up quite well, because 62.7% of the total exit value is from the top 10 exits. So basically, only the big guys, the big daddies are getting the good exits. The smaller players are still kind of getting stuck. And 32.8% increase in PE exist volume. Volume has increased, so it means that Ps are getting exist. So I think 2021 was a very good year. Let's say even stock market people follow. We know the dip which has happened of the Sensex after the lockdown, and of course till recent time the market was doing really good. I think now the correction is happening. You know, again the valuations are coming down, to be very honest. Probably when I do the next session or something of the next quarter, you will see another graph coming down because the market has gone a bit slow now. But up to 21 March, I mean, it was bumper bonanza for all these private equity guys getting exits, because if you see the growth in AP exit value on year 2 years, this is 3 times of their money. I mean, it's pretty good in market. People who's getting three times of their whatever they have invested. And the most popular PE exit is basically M&A. So kind of, so let's say PE guys has come and started a, let's say, put money in one of the companies, and that particular X company has been acquired, and it's in FMCG, let's say an ITC has acquired it. So PE guys are more than happy to sell it off, which is again followed by secondary sales and in open market. If they go for an IPO, they will sell it up in the secondary sales. Hence you see a lot of shares coming down the value, because PE kind of try to, once it is into the market, try to liquidate and get the liquidity back. So coming to the bit of startups, so it has been a record-breaking year for startups, because all the funds which have been raised has been increased by 3 times, and $35 billion are the total funds raised by startups in the current year of 2021. And 85% of such funding is done on late and growth stage startups. What's a late and growth stage? It's not an early stage. Basically, a late and growth stage startups are basically some startups who take some considerable amount of time and then they raise their money. And the top 5 largest funded unicorns in 2020 are ShareChat, Meesho, PharmEasy, Eruditus. These are some big guys which have become the unicorns. And if you see the startup deals, the number of deals and the value, so 28.48 billion value was in 2020 with 858 number of deals happening. And the most common was edtech, fintech. So companies like Byju's acquiring Akash Tutorials, which is IIT coaching. That was one of the biggest edtech deals which has happened. Fintech Cred coming into the picture. D2C brands. There are so many D2C brands. Now, I mean, every brand now tries to kind of create a brand value because that's kind of a good return because the value of brand is much higher because how the closer you connect to the brand, it's very good. SaaS companies, food tech. So these are the 5 startups sectors in funding in 2021, which was in the highest kind of slab. Coming to the M&A overview. Under the M&A overview, there was a 26% increase in volume of transactions, 9% increase in the deal value, and 65% of the M&A deals are of domestic deals. And IT sectors again dominated. So IT is the common name or common sector where all the majority of the transactions are happening. So if you see in 2021, $57.7 billion was basically the value, and the volume there was 889 mergers which has happened. And most of them are domestic. It's not an foreign companies acquiring. Inbound, outbound is happening, but mostly it is the Indian companies buying out Indian companies. So this is a basic. So what my objective is to give you an eye opener about certain numbers which is happening in M&A, private equity, venture, so that we kind of get some an idea for us where you have to kind of explore it within your clients, like in your clientele, who has that capability of taking it to the next level. Like it should be an advisor because most of them are from the traditional business houses, and there's some family of businesses like traditional age-old family businesses they do, and we are their auditors sometimes, or we are their tax consultants. So basically, they are very happy in their own setup because it's a tried and tested, and people will be very reluctant to kind of explore what is an M&A, what is a private equity. So and trust me, with my experience, certain PE deals which has happened is basically, I can't name the company, but it is a very old traditional Marwari business house which has gone into a private equity. Like initially they were bootstrapped, they were happy. It's an Indian ware company which were happily doing a turnover of 40-50 CR with 3 stores down south, and later on they were bought over by a big guys. I mean, I can name the acquirer. The acquirer was Manyavar, the Indian ware. They acquired this company or the client of ours where they were doing a traditional setup. Then we kind of advised them, listen, traditional setup will give you your regular. You'll be happy, you're good enough, but where do you kind of make your money big? So now we all know Manyavar has gone for an IPO. So even of course, once they kind of bought it out, it was an amazing structure which we could do, and we took it to the next level. And or else it was a traditional business with 3 stores here down south, happily doing a turnover 40-50 CR with a good EBITDA margin of say 20-25%. But that would have been continuing. But now as the next generation are coming up, they understand this M&A game, this PE game, where you have to kind of understand yourself and then trying to get that thing in your client's head. There is a way of making your business into 10 times X, because I think with technology coming into the picture, there is no barrier, there is no physical barrier. We can trade, we can buy anything anywhere. Like I'm sitting in Hyderabad, I can buy probably anywhere across the world if I want something. I should know which platform it is and I should have the money to buy. That's how the entire market is running right now. Now just moving into the M&A overview sector. Sector-wise, again, as I discussed, consumer discretionary and information technology is having the highest rate of attraction. And few of the biggest M&A deals which has happened in domestic was Diwan Housing Finance Corporation, India Ideas, SB Energy Holdings, Air India, and Fullerton India Credit. So these are the key big size, big tickets M&A which has happened in 2021. Again, so what I showed previously was basically a private equity or a startup kind of thing. Now M&A, and in which cities? If you see, the states are common, the cities are common. I mean, nothing beyond this geography than that. There are happening one or few in the other part of the country, but these cities, Delhi, Bangalore, Bombay, Hyderabad, Chennai, are being the places where the number of deals happens the most. So I think here we should understand if like probably if there's 122, 164 deals, 161 deals in Delhi. So I mean, if there are deals happening today, we are sitting I'm sitting in Hyderabad, you are in Chennai or Bangalore. There might be a deal happening right next door, but are we aware of it? So we need to kind of understand which are the sectors where the deals are happening. So I think we should all understand. I think we should take all our client portfolio and take up which is company to an IT servicing company, which company is basically into it's a consumer discretionary, which is into a ed tech, which is a fintech, because these are the certain industries where there is a lot of traction happening. If we know what the investors are looking for, is basically you have to look from the eyes of the investors, like in what sector the investors are looking at, where they want to put in their money. Do I have a clientele in that? And if I have a clientele, if they are good, can they be guided? So these are certain questions, because at the end of the day, we all would like to get involved in such deals. And what do we do? How do we do it? There are so many now small sized, mid-sized investment bankers, or because at the end of the day, you understand your client the best. No one can take your client away from you. So certain structuring of the deals, how it's working out, kind of get connected with people who are in this line, and this would basically help all of us to understand how does this entire scheme of things work. So this is so right now in this first 30 minutes, I kind of gave you a small brush up with respect to what is a DC, what is a PE, what is an M&A, and what kinds of deals, what is the size of the deals, what are why is it happening, how is it happening, which part of the country the deals are happening. So let us understand a bit more with respect to the private equity. There's a very famous saying by Paul Krugman: not all private equity people are evil, only some. So people have this notion, if there is a PE sitting into the board, into our head, or if they invest into our company, the promoters kind of gets diluted. The promoter say goes down. Well, to an extent it is true, but at the end of the day, if someone is writing you 100 crore check and giving it to you, they would definitely be worried where the funds are going, because the success ratio is pretty less. If you see, it's not more, because once the money comes in, the promoter kinds of burns the money in certain, probably a lavish office. People, I don't want a lavish office property, then they can work from home these days, but they like to spend on a lavish office. So where the spending should be done in a very, very systematic way, in a very rational way, because people think it's not my money and I can burn it, but that's not the way, because the clauses these days in private in such deals are so strict. Like there'll be a clawback clause, and if you don't achieve your numbers, you might end up like, if you see today, we see those big news like 100 crores is my valuation, 200 crores is the valuation of the company. Of course they are the valuation as on today, but how much equity is left with the promoter at the end of the day is the question, because with all such clauses in the shareholders, in the SHAs and everywhere, excuse me, the shareholders agreement and everywhere, there are all the, like, the private equity players will save their skin in every possible way by putting some clawback ratchet clauses. There'll be some performance clause, like if you perform this much, then only you will be able to sell your equity, or if you won't, there'll be lock-in periods. There'll be so many of them. So most of the promoters are not really comfortable opening up, because once the private equity guys come, he becomes an open book. Like everything becomes open. He has to show his books of accounts. He has to kind of show where he has previously made few investments. What is everything, because will be a big due diligence which will be happening before anyone writes a check to some. So yes, that's why people are a bit reluctant, and everyone thinks they are evil. So as I was discussing, what is the type of PE and VC funding? So usually it is in kind of four different, like in four buckets I would put it up. One is by stage, one is by size, one is by type, and one is by specialization. So if you see by stage, venture funds are basically which are into early stage businesses. What are growth capital funds? Growth capital funds are basically earlier mid-stage companies with established business models. So when the company is having an established business model, it is run and generating revenue, being bootstrapped, then such funds come into the picture. Buyouts or leverage buyouts. So mature businesses usually take a controlling interest and leverage equity with substantial third-party debt. So basically, if you want to buy out some company, there are specific buyout funds these days who kind of does such transactions. There's something called as the real estate funds. Real estate funds are basically focused on asset-backed investments, and there are funds of funds as well. So basically, I mean, if you ask me, how do I kind of understand? So kind of just Google out what are the different types of PE funds. There are certain. If I just skip the first two bucket and come to the last bucket by specialization, there are certain private equity firms who just does investments in the pharma company or an infra company. So they'll be specifically kind of create their objective, their investment thesis. That's what they call. Their investment thesis basically by specialization. So if you see the sector focus is technology, healthcare, real estate, then there are certain sectors which is very famous these days are impact funding. Like if you see a company like which is into sustainability, clean tech, these are the few companies or the startups which are in these sectors are getting funded these days by some impact sectors because of environmental challenges and everything. So there are funds which specifically provide such funding for such companies. If you go by the size, excuse me, I've already discussed that venture funds are basically nothing but early stage investment companies, just into $1 million to $5 million. Mid-size mid-market companies are usually investment deals worth 10 million to 200 million. And of course, mega funds are the large buyout funds. These are the big houses which kind of done the mega funding. And by type of capital, Ps will definitely be taking equities, but they kind of take equities as convertible debentures usually. So what happens is that it will be just like a loan to you, to our company or a startup. They'll put in money, they will issue some convertible stocks, as the convertible debentures on achievement, and you'll be paying interest on that, or probably interest free, depends on the terms how we get it. And probably after some time, once you start achieving the numbers in the business plan, what was shared by the startups or by the companies to their VC guys, based on the achievement of certain revenue or whatever is the target triggering point, those debt will slowly start becoming equity. And mezzanine is nothing but mix of equity and debt structures. So there's a lot of structuring you can do. Of course, that is basically how VC or PE kind of positioning themselves in the company. But yes, these are the kind of the two basic type of capital which is required. Now let me come to certain private equity bits. So let me start looking into it. What the promoters, probably when I approach my clients, like I ask them, do you want to get into a PE or an M&A? The first question the promoter will ask me, listen, Aditya, good, you're thinking about it, but listen, I don't want to lose the control of the company. That's the biggest problem in our Indian market or the Indian promoter mindset. I mean, they will be losing money left, right, and center, but still they don't want to lose the control of the company. But trust me, it's a different perspective, because if you get a private equity, guys, the promoter still has the controlling power in the business. Their decisions will be kind of pushed onto him. But the partner please read it as a private equity, guys. The private equity guys brings in the new perspective, because they have invested money in so many companies. They have a big bandwidth. They have guys from the big B schools handling their portfolios. So basically, it is the promoter's knowledge about the market, which is, again, no B school can teach you. I mean, the promoter's experience, let's say, guys, let's say the MDH masala is something which comes in my mind, because So ITC is kind of trying to acquire that company, but promoters knows this. He might be a 10th pass, but he knows his business the best. You get the biggest IIT, IIM, CAs, so nothing beats a promoter's thought process, how he knows his business. But at least what the PE guys will bring you is a new perspective and operating efficiency, the capital. That's the most important thing, because money is the most important thing for us to run it's like the fuel in the vehicle which you put it, because if you put the fuel, the vehicle runs. Similarly, if you put the capital, business will run. Second, it helps in short-term capital and not long-term capital. That's another kind of a myth. But all it depends on the investment cycle and team framework. Excuse me, just have some water. Thank you so much. So basically, I was telling the game. So it depends on the investment cycle and the timing framework. And the exit windows are usually increasing. It is not short term anymore. Earlier, the private equity guy used to put in money for 1 or 2 years. Put 1x, make it into 5x and leave in 2 years. No. Now the market is changing. The P's are sticking into it. Now average, it has increased from 3 years to basically 5+ years. The PE guys are sticking with us. So, and another third myth is the only option if traditional finance not happening. So basically, if there is no debt, so I get the one. I mean, still in some the market which is not matured in India, they will try to look in for debt. Now, only if they're not getting any debt and the promoter is out of sorts of not getting their own funds, they will kind of get to the private equity. But that's not the case anymore. Now, basically, there can be a strategic dilution, which is very important. Let's say there is a facility management company who does the entire cleaning, security management, and all that in a big corporate, big business parks. So these days, the business park is kind of acquiring these facility management companies. So this is called as a strategic dilution from the in the facility management company, because for them, their main customers are these business parks. And for business parks to kind of look for vendors all the time, it gets very difficult. So they kind of try to buy out. So these are called a strategic dilution. Another strategic dilution example I gave you, there is a big listed dairy company from Hyderabad whose main basically business is by dairy farm, by selling milks. But they went ahead and bought a organic fodder company, so which basically manufactures the food for all the cattles. I mean, they could easily buy it out. I mean, from the vendor, because they were their vendor, and later on they kind of bought their vendor. Because what happens is that when these companies kind of buy such companies, it creates a story. For any PE investment or for any IPO, there's always a story. Because how to basically perceive, like the thoughts, how the investors will think about how the story of the company should be, like they will start acquiring the smaller players. They will start doing some strategic dilutions. They start acquiring companies which are into their similar line of business, or into like I just gave an example of the fodder company, or a dairy farm buying a dairy company buying a fodder company, or a facility management company is bought by a big business park real estate companies. So these are some strategic decisions they do for their storytelling. Another myth is basically PE funds only keen on new age technologies companies. So basically, this is a very it's again a myth. I would not, for me, this particular point is a bit debatable, because it is not always like that. But what happens if new age and tech sector gets frequent media coverage? Because mobile, I mean we all know how much of, after Jio coming into the picture, the rates of the mobile, I mean the data charges are one of the cheapest in the world. I think there's an amazing report by Deloitte with respect to how the mobile phone usage in the country is happening. And trust me, I mean we are lucky enough to get the data so cheap. So hence media also gets the attention. People use it. Everyone has a smartphone these days. And the private equity capital is chasing larger businesses in most sectors. So they kind of chase the big guys. So yes, to an extent, I understand the new age technology company is PE funds are keen, but it's not always like that. I mean, they of course. So if there is a traditional business, big business, which is backed by a tech company, nothing like it. They say business is too traditional for PE investments company. And my point is, you don't have to be a perfect business to transact with PE. I mean, that's where we come into the picture, because the business, we all know, matter of fact, the how the business runs in a very proprietary way with less controls and the risk. So basically, all your RCMs might not be in place. People follow, okay, if my boss is telling it is correct. So it's all a very, very traditionally driven, 1% driven PE. So promoters think that, yeah, I'm a 1% driven company. PE people won't find investment in it, but it's not the fact. I mean, we know that you don't have to be a perfect business to transact with PE. Your business idea or what you do should be perfect. If you are still having a traditional business and still making money, that is important. Another myth is basically PE funds only interested in distressed or capital assets. So basically, that's there, but PE funds, there are separate funds for this, something called as distressed funds. So distressed funds are such funds who kind of invest in such companies which are into distressed and kind of not performing well. So PE invests in such companies, but there are specific funds, as I said, specific funds focused on distress and turnaround deals. And people say it's too risky. I mean, let us understand, it's like a marriage. How you navigate matters. So basically, it is just like a marriage, to be very honest. It's basically amalgamation to the private equity and your company, how you kind of come together and make it big. These are the certain myths I wanted to, because these are the certain questions we receive it from our promoters, of our clients. Like, how do you do it? I don't want to lose the control. It is risky. It is too traditional. I don't want. I'm happy. What am I doing? But yes, you have to kind of open that thought process. Honestly, if I speak to 10 promoters, 9 will say the same thing, but there'll be one promoter who will be able to understand, or who will be able to conceive your idea. And that one promoter will kind of make it big for you.
Sir, tell me, sir.
Yes. Yeah.
Calling you.
Sorry. Yeah, there was some issue with the net. That's fine.
Now it's fine.
Perfect. Yeah, I'm continuing it. Yeah. Yeah. So now continuing it, delivering value beyond money from an investment. So basically, how do you kind of give value? How can a CA kind of like us give value to this, basically to the investors? Or because kind of when the investor comes in, so the investor, it is basically, this slide is basically, this way we have to tell to our promoters what will when the investors bring in, what is the value they will bring beyond money. First is the global perspective, because these people have their, like, let's say a Blackstone or a Motilal Oswal or any of these private equity guys have their money in so many buckets, like in so many companies. They kind of give their global perspective. Like, it will help to create a foundation for global expansion by enhancing customer and vendor network and leverage portfolio synergies. Let's say today there is a Chennai-based company which is into manufacturing of plastics. So if a private equity comes into the picture, as their money is involved, they will also open up of giving you certain customers, certain vendor network, certain portfolio, because they kind of they kind of deals with such companies, or there another company who they have invested might be your customer again. So it kind of give you a very good global perspective, and it kind of opens up your clients' doors for such global people. So it's independent third party perspective. So with the global market, what is it happening globally? This kind of opens up a lot of picture. Second is, the most important thing is a professional approach. When there is an outsider's money coming into sitting in our business, the promoter has to kind of enhance their corporate governance. and their reporting structures have to be kind of the best. So here I just want to add one thing: the professional kind of our services comes into the picture here, because the hell lot of MISs which these private equity investors asks from the companies they have invested in, and these companies are small scale and they don't have that bandwidth. So they kind of appoint us or consulting firms like all of the chartered accountants, CA firms, who are of course not just statutory auditors but for other services, because certain MIS needs to be delivered with so much precision, because if some number goes wrong, it backfires to all of us. So some reporting structures, so I see so many firms kind of doing this, giving probably tying up with such companies who has a private equity investments, and then kind of helping them develop their own internal reporting structures, because these companies just want to run their business. They don't feel like, they don't want to waste their time doing this paperwork. So this is the paperwork, or rather this reporting which we can do on behalf of them and give it to the investors. Attract talent and visibility. So if today these days, if you just say that earlier it used to be like, I have started a company and so X person invested in it, they'll all think about it. Okay, now we know that there is a company, I think, where Virat Kohli has invested in a shoe company or a apparel company called as ROM. Anushka Sharma, Alia Bhatt, these are all the big names. These kinds of attract talent also from people, because these days youth, it's very difficult. We all have issues with respect to the people there. There are a lot of people issue, attritions. Everyone faces it. But at least when there's a PE firm's name added to your company, to your client's company, it kind of gets the credibility and which attract talent from across the globe. Of course, enhanced credibility and financial advisory support is also coming into the picture, where access to additional funds as well as M&A activities, access of in-house financial experts, and helping in running an effective IPO process. Now, let me tell this point. Once the investors have put in their money, now they have to stick. So they don't want their hands to be burnt, because if they put in money and they kind of take a back step, I mean, it can be a possibility that the money has gone into the drain. They don't want that. So these investors kind of carry a lot of financial advisory support and enhanced credibility to these companies, because they want their money to be doubled, tripled, and the money can only be 2x or 3x only once if the business performs. That's the most important thing. So that's why they will never move back, rather they will support such companies. So this is a very good saying. Again, I feel like Bill Ackman. I think good private equity investors create a lot more economic value than they destroy. Because it's the entire perspective of the myth, bursting it out. Of course, there is a lot of destroy, as in the mindset that destroys and everything which has happened. But it is basically a company which is going into good private equity investors will actually create a lot more economic value than they destroy it. Investors' perspective and case studies. So let me just jump into this slide. Preferences of a PE firm towards investment. So these are the 8 points which we all have to look for in our clients. If you think these 8 points are ticked, then it is a kind of a very, very attractive for a private equity firm for them to invest. So PE investors look for performance-driven companies with a clarity on business plan that may present a unique multi-bagger opportunity due to uniqueness of idea, implementation with a high growth and scalable target market. So business plan is the most important thing. And what is the model? So the first point, if you think your client or you as a entrepreneur, you have your own businesses, or as most of our practitioners here. So Manav, does your client kind of sits in this picture? First is it has a strong growth potential and scalable business model. Most important thing. If the business model is flawed, nothing can be done about it. I mean, no PE firm will come into the picture. Second, beyond prototype stage, that is with proven revenue models. That's what I was discussing in the starting. If your client with their own money is generating consistent revenue, which is basically a proven revenue model or beyond prototype stage, then it's a very good ask for your client to basically get attracted to a PE funding. Third point is basically growth capital with clear scale up strategy. Is there a growth capital? Growth capital with respect to the strategy, whether do you have a capital, and if there is a capital, or if you get a capital, is your strategy clear? Is your scale up clear? That is most important. So if there is no strategy, there might be money, but if you don't have the strategy, then money goes nowhere. So there should be, now let's say it is basically money is the only hindrance for your client for not scaling up. In short, that is the entire agenda in the third point. If there is money, I have my team in place, I have my product in place, I have a strategy, I can run. Fourth point is 3x and 5x implied exit IRR. So basically, if you can excuse me, I'll just have some water, please. Really sorry for this, having a really bad throat. Yeah. So if the private equity guys are basically when they see that their money can be multiplied 3x or 5x times the IRR, the internal rate of return, implied exit IRR, then it's a very attractive investment for them. Fifth point, attitude and ability to maximize shareholders' wealth in spite of dilution. So the ability and the attitude of the promoter, basically, they're talking about. So in spite, because see, once you are a promoter, you are 100%, your client or you yourself is 100% owner. When a private equity comes in, probably you become a 49% stakeholder and your private equity guys become a 51% stakeholder. But do you have that same enthusiasm of like, okay, it should not be like, okay, now I own 49% and whatever I make, I'm not going to get, like if I make 100 rupees, it's 51 rupees, it goes for those private equity guys who doesn't put any efforts, but they have put in money. So they see what is the attitude of the entrepreneur, whether they want to match, they has an ability, because because that promoters today's 100% will be less than of tomorrow's 49%. Because if today the company's valuation is 100 crores or let's say 10 crores, after the dilution, when the money comes in, is that valuation is 10 crores or 100 crores? So today if he sells the company, he'll only get 10 crores, but if he gets the private equity guys, does a dilution, takes a 49% stake, and in next 3 years, if he can make the company's valuation 100 crores, his exit will be at 49 CR, not at 10 CR. So whether that ability is there. Sixth most important these days is asset light models. So basically companies that which is, see, it should not be very machinery or very capital intensive model. Asset light model works the best today. Let's say they have an office which they have not taken an office space, they're all work from home or taken a co-working space. So asset light models are very much preferred by a PE guys. Number 7 point is basically strong exit possibilities. So most important is, okay, if I'm putting money today, am I able to exit? What are my exit options? Is my exit options very clear? Or will there be a hindrance while I'm exiting? This at the 8th, the most important point, clean promoter background, which in our country is very rare, and on a lighter note. But yes, this is the most important aspect, because at the end, it is all your attitude, it is all the promoter's thought process, his ability to make it big. So clean promoter background is one of the key criteria which a PE investment takes or undertakes, the PE firm. So these are the few 8 points. I think this is a very useful, because at least this will help us to know whether in our clientele are they meeting these 8 points or not. Coming to the next slide. What do PE investors look at apart from the preferences of a firm? So once the preference is taken, what do the PE investors look at? First and foremost, if you see, is corporate governance. Whether the corporate governance, my corporate structure, promoter profile, and organizational structure is sorted or not. Now, what are the factors which are leading? So let me just go through the stages. So the first stage is basically they first check the corporate governance and metrics, then the operation metrics, then the market metrics, and then comes the financial metrics. You see the flow. It's not financial first. It is always the corporate governance, because if you see all the startups, say Ola, Uber, Zomato, they name any Rapido, they're all burning money. So they're all at losses, right? They're not a profit-making company, but still we understand, or yeah, their EBITDA losses, so they have a negative EBITDA, they have a negative PAT. On what basis the valuations are coming in? It is not, but that's why financial metrics is kept at the end. It is more with respect to the corporate governance metrics. What are the intentions? How is it structured? How strong are their operations, and what are their market metrics? And then comes the finance. So let me just run you through the factors. So with corporate governance, it can be basically tax optimization and treasury management, transparency and disclosure, related party transactions. I mean, trust me, in my few of my clients, everything was going fine, but because of many related party transactions, the deal didn't go through. I mean, that kinds of, I mean, even at the term sheet level, the related party kind of, there's so much transaction with respect to the related parties, there was so much holding, cross holding, but transaction fell off there. It is very critical to kind of keep the related party transactions very clean, having it, of course, in arm's length, and of course should not be confusing. There should not be intercompany. There should not be too many holdings or cross holdings in the company. It should be straight and clean. It kind of attracts the PE guys. The structure, as I was talking, how the legal entities are grouped, what is the nature of the companies, promoters' willingness to expand, previous experience, succession plan, very important. Because in India, it's the succession plan kind of business work. So do they have any, or is there any family dispute? Because in these mid-sized companies, we have seen there may be so many family disputes. Then a transaction falls after that, because there'll be cases filed against him, by his brother, by his sister, to anything. So when they write a check, trust me, they go to such a granular level. All these things will matter. Most important, people and process driven. Organizational structure, is it a people driven or a process driven? How are the team organized? What is the quality of my manpower? These are again very, very important points with respect to certain factors which we have to kind of zero in. My operational matrix, which is basically nothing but mapping and benchmarking my operational efficiencies, my macro challenges of the business, the regulatory framework, the cyclical business, the service capability, continuous innovation, enforcing market disruption. So whether I am prepared for any market disruption or not, whether there is a risk of concentration, which is, am I getting revenue only from my one single product, or my input is my material dependencies from, let's say this example of the chips. We all know there is a lot of issues with respect to car manufacturers now. Probably an average waiting time for a Mahindra XUV today is 6 to 7 months. Why? What's the issue? It is basically my input material dependencies on, say, China. And China's, again, the main chips again get manufactured in Ukraine, and there is a war in Ukraine. So there's a lot of things, whether this concentration is very, very important with respect to your regular operations, because of an external factor, whether your operation will get screwed up or not. That's what they look into. Then coming to your market techniques, what is your go-to market and scale-up strategy? Is there a clear market segmentation? Is the company's product and monetization strategy, is the product categories niche? Is the business diversification before time? So if I look at all the factors, what comes to my picture is, as a chartered accountants, as their auditors, as their advisors, these are the certain factors I think you should kind of inculcate in your client's head. And listen, these are various important things. Let's say you want to go for PE today or not, but the second generation doesn't want to continue the business, then what you do? You kind of sell it off. So but making your company PE investment ready is basically getting all these factors right. This is we come into the picture. How do you tax optimize it? How do you give a disclosure norms? How the people in India, the disclosure norms is an issue. But luckily, after India's coming up into the picture, the disclosures of the listed companies have improved. But still, it has the companies who are still standard accounting, old accounting standards, their disclosures are still an issue. So slowly, I think India is kind of now with all this global, India being the eye of the global market, slowly the IFRS and India's are almost at par now, except for few carve-outs in some standards. It's kind of similar. So right now we would like to understand where as a CA can you kind of advise your clients in kind of correcting these factors line by line. Because trust me, one tick of every tick will kind of fetch an inherent or an intangible benefit to your clients. Coming to the market of competitiveness and brand recall, huge market opportunity, product market fit, brand perception. Is there a brand recall? And what is a brand recall? I mean, in Chennai, if I see Ramraj shirts, I mean that any white shirt reminds me of that. That's a brand recall. So if I want to order a food, Swiggy or Zomato, that's a brand recall. So does your client's product kind of fit in any? Does they have a brand? If they have a brand, are they valuing that brand? That is very important. Financial management and discipline, growth track record, low leverage, low capex and proper opex planning, proper capital budgeting, proper working capital liquidity management to avoid risk defaulters. These are again, we are all aware of all this part with respect to the financial metrics. Now, how to be an attractive target? Now, how do you basically tell your client? How do you basically tell them if you do, you will be an attractive target for a PE investments. So basically, we have to be aware of the pitfalls between tax optimization versus valuation. Now, what happens in this is, client always tells, which is because my article shift desires to kind of listen to it. Arey mujhe tax aisa plan karo, kuch like plan something where I have to, my tax output is low. Trust me, these persons will not get the valuation because for that they do certain adjustment with respect to the reduction of the revenue, increasing their loss, whatever adjustments to be done. Because there's a difference between tax planning and tax escaping the tax rather. Even that's what the word is, beware of the pitfalls between tax optimization and valuation. Even you should not look into paying of less tax today, because trust me, if you show more revenue, if you show good EBITDA, good profit, your valuations now these days, if you know, the valuations are always based on your EBITDA multiples or your revenue multiples. And they of course take the last 5 years or 4 years average. It's not that they take only 20. Let's say your company is getting sold and you want to value the company, they will not consider only last year's numbers, they consider last 5 years numbers. So your valuation of course should be somewhere in between your, so you should encourage them to basically show the numbers proper, show it more rather. Of course, should not more as in show the correct numbers, which is basically reflecting in your return, because that will help you to enhance the revenue of your company. And of course, the valuation will matter on the revenue multiple. Promoter KPI, identifying critical success factors. Promoters KPIs, and promoters should kind of try to upscale or themselves. What is my promoter's basically knowledge in this? How am I valuing my promoter is very important. Art of dedication. You should tell your target key. Are you having a team for it? Management by exception versus management by supervision. Create financial metrics and internal control mechanisms. So that's what we say, right? I think the most important, most beautiful concept our institute has come into the picture is the IFC part. I mean that The fourth point is nothing but your internal ICFR, internal control over financial reporting and internal financial control framework. This is the most important part of any organization because that is that particular framework which kind of takes care of all our internal control mechanisms. But I mean, on the reality, we know how many company does it and does not. The difference between good versus great. What is which is basically nothing but operational efficiency versus clear strategy. My promoter profile. Reputation is everything. Ensure no financial dealers as default. As I discussed earlier, simplified holding structures. Arm's length transaction between related parties should be very clear. Documentation and patent of IPs. Many of them have their IPs, but they're not documented. It's very important to document all the IPs. And awareness of competition and adaptability of market trends. This is again very important. You should know what is happening around you, and you have to adapt to the market trends. Yeah. So if you see this cartoon on the right side first, I mean, that's very hilarious. People say if at first you don't succeed, you merge. And also on the left side of the things, basically like, are you thinking what am I thinking? There are mergers happening there. So it's basically meet of what is this image is saying is basically a meeting of the minds of two people. So merger will happen, of course, if there is meeting of mind. And of course, if certain companies are not able to, they might have a talent, they might have a resource pool, they might have the best teams, but they don't know how to sell and where to sell. So you have to kind of do a strategic merger with respect to companies who's good at it. Certain successful stories. The biggest deal in EdTech was basically Byju's acquiring Akash Education Services. I think Akash is pretty famous in the northern part, but there are so many. It's like just like a Fitchi, or there's so many tutorials for medical and IIT, where Byju has acquired Akash Education Services for an estimated $1 billion cash and stock deal. The investment was driven to extend the Byju's footprint in the offline segment. So Byju's is basically an online segment. We are all aware of it, but Byju's wanted to get a foothold with respect to the offline segment, because Akash is a completely offline segment, and so that was their kind of a strategic move. But if you see at the end, Akash Educational Services will function independently, and Byju's will accelerate the growth. So it is basically tech meeting a non-tech company or having a physical classes. So that's I think that was the biggest EdTech transaction which has happened. And if you see, there is Unicorn acquiring a listed company for the first time. I mean, there are listed companies now. There was a unicorn who has acquired a listed company. That's a trademark kind of a story with respect to pharmacy and thyrocare. Like online pharmacy setup pharmacy is acquiring a majority stake of 66% in a diagnostic chain called as Thyrocare Technologies for 4,546 crores. The investment is driven by diversify and strengthening the testing business. So pharmacy being an online startup kind of acquiring a Thyrocare Technology is a listed company. That's a very unique transaction which has happened lately. And some successful stories is basically Barbecue Nation, the famous restaurant that CX partner exit. This is one of the exit story, where the investment was driven by a uniqueness of the format and ability to scale up quickly pan-India, quality team and replicable SOPs, transparency and disclosure, and enterprises software for IPO. CX partners, the PE firm, kind of existed in 2.8x returns in 8 years under the F&B sector. And here basically Motilal Oswal and AU Bank, there was a transaction here. So basically, if you see, the Motilal Oswal private equity has put in 40 crores across 2 rounds of investment in 2008 and 10 and made 30x returns. So subsequent investments were by AFC, Damask, Warburg, Nomura. These are all the private equity fund houses. So basically, to start up the brushing up the skills, what I have also done is to understand what are these various fund houses. What does an IFC do? What does a Temasek do? Where you're there, what you go to Tamasek's website or go to this Motilal Oswal's private equity CX partners website and see under what sector they're investing. whether these sectors is aligned to your geographical jurisdiction or not. And I've told you earlier in the slide that Bangalore, the Karnataka, Tamil Nadu, Telangana, Maharashtra, these are the hot parts or hot happening investment states in the country. And there was a packaged foods. I mean, if you know ID, famous your idli dosa batter of IDs is kind of Azim Premji invested in it, which has attracted at $25 million. And in Azim Premji is also invested in Fab India. So these are the certain major transactions which has happened. And under in healthcare, so there was this is a stories which has gone sour, like which it didn't go well. Now I showed you the good part of it. So here in the healthcare part, there was an overvalued. If you see, the initial deal was done at $270 million value at an EBITDA multiple of 21x. So the deal on the valuation I was discussing basically is it was done 21 times of EBITDA, but market was only 14 to 16 times. So they became very aggressive. It seems for what was being sold for 14 rupees in market, the private equity guys have paid 21 rupees for it. That's what it means in simple terms. Why? Because it was based on some aggressive business projections and limited commercial due diligence. PEs and LPs accused the money of misappropriation of funds and fired senior management. Exited at a loss to TPG. So TPG kind of took it over, but the Average Group kind of sold it at loss. If you see, this one of our Shark Tanks, this series which started in India, it's a US-based thing, but of course the Indian version of startup, this one Shark Tanks, the Sashneer Grover story we all know. I mean, what happened with Bharat Pay started, he got into the Bharat Pay, then the kind of the board took it over, the investors kind of backfired him. So the entire story is kind of a case study for this, where things when doesn't get wrong. I mean, that was his baby. Now he's out of the company itself. So that's how it works here. There another was basically an apparel company called as Bain Capital or Lilliput sues the auditor of the misstatement. So basically, the Bain Capital is the private equity, Lilliput is the wear for the children apparel wear. And the initial deal was at $60 million, and Bain Capital sues EY auditors for falsely auditing the financial statements. I'm not coming into any conclusions here, but this was one of the cases where happened the numbers were apparently not shown correctly. And there were certain challenging deal closure stories. If we know the famous on the right side, the famous Paradise Biryani, so Hyderabad, I think you guys have known. So now currently the promoter stake is being recently diluted. He's hardly holding 3 to 4%. The main owner of Paradise is being held by Samara Capitals, and they have opened stores left, right, and center. I think I don't even know if probably Bangalore has a Paradise today, Calcutta has a Paradise, so everywhere it is there. So what happened was that organizing the unorganized. Basically, Paradise was a typical. There's in Hyderabad. There's the concept of the Irani hotels, small tea cafes. It was a small tea store back in Secunderabad. From 1953, used to sell biryanis. So it was completely cash business. I mean, even I remember when I was in school, I used to buy biryanis from there. They used to not accept card or anything. It was always cash transactions. And we know in so many hotels and all it happens. So imagine a private equity coming into a setup like Paradise. If this deal has happened, it was almost, I think the first round was it was more than 100 CR, the valuation of Paradise. So basically, if you see, a substantial cash business investor had to appoint a big four firm for 3 to 4 months to estimate the real cash flows from the business. It is the world's largest single entity consumer of basmati rice, and now format is in multi-city. So when the promoter says I'm into cash business, so what? If it's a cash business, it is generating cash for you, which is very important. So they had an enterprise like Paradise also kind of get funded with some private equity like Samara. So what is ready, set, go, getting investment ready. So the most important part is here, how am I making my companies to be investment ready? What can a CA do? This is basically what can us. This was some 8 points I might be wrong or right because I don't come from a practicing background, but yes, this is what something which we can do, I feel. The chartered accountants play a major role in developing the promotion and growth of firms as in your clients. The first most important role for our professional is to guide our surroundings sectors about benefits of the deals through lights towards the growth opportunities. First is awareness towards different financing sources. I mean, it should not always be if a promoter needs money, it should not always be debt. I have explained it can be P, it can be a MNA, it can be a debt fund these days is very attractive. I think all of you should look out for something called as debt fund. So debt fund works very similar to how a private equity firm works, but it's completely that the structure is kind of a debt. So that's a very attractive thing. Take steps towards availing benefits of funding. Do the identification of investors. If you feel that your client is basically into something where there is a bigger player or a strategic investor can be added, why not look for it? Open doors towards synergy building. Update and aware of changing market for competitive advantage. Enlightening towards deals and funding. So, I mean, when we get some transactions, we kind of look into the story. We kind of do our research with respect to, let's say, agri-tech is very attractive as India is mostly still an agricultural backed country. So there's so many agri-tech startups which has happened. The few from Chennai, few from Bangalore, few from Hyderabad. There's so many companies, agri-tech companies where agriculture and technology is being mixed. I mean, there's so much scope in that. That's what I'm trying to do is based by the changing of market opportunities. You have to find where the market opportunities for your client. Encouraging planning instead of evasion or pretend ignorance. Digital team formation of financial tax and regulations. So basically, how can you digitize everything? How can you basically there are certain pointers. If your investor is coming, if they ask for some financials, you can tell everything is in the cloud. This is where you can access it. So kind of please, now we all need to get that technology into our traditional business houses. This is very important. First, we all kind of need to be technically aware. And second, with respect to making our clients technically aware about the things. But I think this whole pandemic work from home forced few of us who were not into technology adopt technology. So that was really a blessing in disguise for us. Dimensions of investment readiness. So this is basically on dimensions and area of consideration and significance. So where, example, how can you make your client investment ready? As I discussed earlier, this is more into the detail where if it's let's say let me take up organizational structure. Is my senior manager competent? What is the skill assessment framework? What is the employee retention and succession? What is my employee compensation? It should be basically identification of management and employee competency. So these is basically various areas of considerations which kind of we as an auditor or our advisor to our clients, we have to look into it. Right from market and industry, business model and operations, organizational structure, historical performance, growth strategy and financial projection, capital need, governance structures and exit options. Now let's say what is a typical time process? So basically, let's say today your promoter have decided like, listen, I think I feel like I want to dilute some stake. Let us get some good guys, good investors, and let us kind of start looking into it. So before someone comes into the picture, they will of course see your books of accounts and everything. So your pre-investment preparation for your client should be basically the time and the process. What is the first thing? First thing, getting the financial cleanup done, getting all the compliance updated, getting closing their corporate governance part, and also branding and market positioning. So all this will usually take 6 to 12 months of time with our experience, what we see. See, if you have, there should be a brand recon, very most important aspect in that. Of course, because there is a brand recon, but there is no financial cleanup done, then it's wrong. So it should not be like you got an investor, you have done the entire deal preparation, you have done the investor activation. It should not fall at term sheet stage. So in usually what happens in our Indian-based companies is basically we will do all the pre-investment. We will not do the pre-investment operation. We will start from the second stage, deal planning. We'll get this deal. We'll prepare an IM and FM, which is very easy part. We go prepare IM and information memorandum is nothing but a 2-3 pager for or a small pitch deck with a financial model which tells me the projections. I will identify the investor. They will buy it. Then after they're happy with their thing, they will give us a term sheet. Term sheet is also non-binding for your information. It is not that if they sign a term sheet means they are going through the deal. After the term sheet, then comes the real picture, your due diligence and your definitive document. This part is the most critical part. So all the hard work which you have done from deal preparation will fall if you don't do your compliance or financial cleanup early. So many people forget the pre-investment preparation and they always go ahead with from deal planning till the negotiation, and the deal doesn't go through. That's the problem. The deal doesn't go through because it fails in the DD. 98% or 95 to 98% of the transaction falls in the DD stage. Because why? Because there was no pre-investment preparation done. So the most important, if you ask me, is this part, the pre-investment preparation, which is for 6 to 12 months, wherein the corporate governance, the financial cleanup, compliance, brand building is done. Because you have to create a story, and a proper story will only sell. So if you see, the 6 to 12 months is take for a pre-investment preparation, then the deal planning and preparation comes, which usually takes 1 to 2 months, where you understand and evaluate the historical performance. Then you see whether your historical numbers is now matching with your provision, what you are foreseeing. Let's say your past history, last 3-4 years historical CAGR growth of your revenue is 8%, and suddenly in the next year after funding you show it 30% is odd. So there should be some rational. So your historics numbers should be a good background or supportive with respect to what you project. Then you, of course, your preparation of information memorandum and your number projections and your industry overview. Once these two things are prepared, then you come for investor identification. Under investor identification, what you do is you have to identify your target investors. Who are the people whom you are targeting? Who are the fund houses? Then you have to share certain information. You will be sharing on a non-disclosure basis the information memorandum and projections, and these all things happens on a no-name basis. You kind of give some name, let's say Operation Blue, Target Blue, some random name you give, so that you don't name the company in the public, because you don't want people to know that this company is for sale or they want to dilute. Because news flies around the market like this, and then probably it is the promoter might not get that value what he's looking for. Your promoter should never be very desperate, or you also should, on behalf of your client, should not be very desperate to sell. There will be hard negotiations, of course, but it should be completely on a no-name basis. Once the investor identification is done and there is some interest, there will be a promoters meeting. If there is a plant, there will be plant visit, there will be office visit, and the most important, negotiation and valuations. So here the negotiation happens. Now here, let's say they offer you 8 times of your revenue. Today's valuation is 8x. You do your DCF factor, you put your valuations, do as per your valuation methodology, apply your DCF, apply your comparable market methods, whatever you do. At the end of the day, it comes into the what multiple of revenue of EBITDA you're giving or of the revenue you're giving. The negotiation happens then. Based on that, a term sheet is issued. Now let's say they have negotiated, okay, I will be giving you 6 times of your EBITDA. Okay, then once I sign the term sheet, it's a non-binding. Then the most important parts of due diligence, which usually takes 2 to 4 months. Due diligence and definitive agreements come into the picture, where all the shareholders agreement, DD will happen. So in the DD, there will be certain issues. Now, if the issues are cleared, it's good. If it is not, then the deal falls. where we kind of, because usually they hire the bigger guys, the big guys who kinds of mergers hires the big four guys. Then sometimes they have, because there are some foreign investors, they might have their mandate with that. If not, maybe decent sized audit firm they handle, and this we kind of do that. We can on behalf of our client, we can do the due diligence support to them, because there will be so much. They will tell us to make a data room. The big data room, all the data will be dumped, and what exact information we need to give, because the quicker you give the data, the quicker the process will happen. And once it is done, then you have a pre and post closure formalities, which usually lasting from 6 to 10 months. So I have this famous saying, in business as in life, you don't get what you deserve, you get what you negotiate. So other than valuation, these are the certain points which is very, very important on how you negotiate it out. Because as investment bankers, or if you're representing a buy side or a sell side, with my limited experience, I can tell that it is all what you negotiate. I mean, numbers will say something, your product might be good, your FM is good, but at the end, negotiation is the key kind of tool for all of us. In the negotiation part, other than the valuation, there are certain called as warranties and indemnities, limitations on liability, restrictive covenants, tax requirements, drag and tag, restrictions on transfers, level of leverage, sweat equity, minority protections. These are various other points on which the negotiation happens. So now, after the negotiation, what are the exit consideration? Like, when does the exit needs to take place? This I'm focusing a bit on the exit part of, like, it's a private equity has now invested into your company. What are the exit points, or what are the exit strategy? So when does the exit need to take place? What is the investment horizon? What exit routes are available? Who are the potential acquirer? Timing of exit, and what kind of returns are committed? So typical total exit, basically, if you see, there are two kinds of exits: total exit and partial exit. Let's take on to partial exit. In partial exit, let's say someone is holding 51% of your shares, of the client's share, they would the PE would like to exit only 25%. So either they will do a private placement, they will do a corporate venturing, or they do a corporate restructuring. And in a total exit, it will usually be a leverage buyout, be a trade sale, or a share repurchase. So it depends on what strategy they do. Now coming to nurturing and enhancing enterprise value. So now, as you just quick recap, I will now probably in the last 15 minutes, I'll be able to wrap this up for you. What we have understood is, we have understood what is the private equity, what is a venture capital, what is an M&A, what are the number of deals, what is the type of deals, how much is the deals happening in our country, which region it is happening, how you should make your client be investor ready, how you should basically probably give options to your client with respect to the different kinds of funding routes which are available these days, apart from the traditional debt part. So these are the things which we have basically gone through that. Now, what is NEEV? NEEV is basically something which we do, and I want to share it with all of you, because this is where you kind of be a selling point for all your clientele. So basically, the NEEV, what we do is nurturing and enhancing enterprise value. So this is what it is. This is basically how do you create value for your client. Like, you kind of see what are your client's goals. Like, you have to do an aspiration setting. So if you see there's a red line dividing two parts. One is aspiration setting, another is solution and approach design. In aspiration setting, you see what are your client's goals. What is the mission and vision value? What are the financial and non-financial goals? And where they want to play. They want to play in the industry, which product, which geography, which clientele. So these are the very, very important things, because you have to if your aspirations are set, you know which road to follow or which path to walk. So once your goals are, once your aspiration setting is done, what are the solutions and approach design which is available, as in how to win? What is the value chain realignment? What is the go-to market? What is your strategic alliance? What is the capital allocation? How do you configure it with good corporate governance, with process driven, with training and development, and how to get it done? by budgets, continuous monitoring, accountability. So this is basically nothing but in one slide, how do you basically show your client with respect to what you need to achieve and what are the solutions on achieving the aspirations. This is the framework which kind of we feel that it is kind of the framework which is very result driven, and it's a strategic framework that aims at a long-term sustainable growth. Because what happens is with that framework kind of enables your strategic interventions across 8 key functions which we have identified, which clearly impacts the growth and value creation of an organization. So let's say, example, I start with the market, product, portfolio, clientele, innovation. These are all your external factors, which are your revenue elements, and your value chain, operational excellence, human capital, corporate structure is your internal capabilities and your cost elements. And your cross-operational corporate interventions are MISs, performance evaluation, continuous performance. So these are all the key factors kind of making the framework successful for your client. And this is a certain way you can advise your clients. And what is the desired future state visioning? The desired future is basically your promoter, your management, and your investors or partners having a common value objective. When this common value objective meets, it gets a long-term business growth and continuity plan, which is nothing but your, so basically your vision, your financial goals, your non-financial goals, your brand equity, and your value monetization. So all this kind of mergers if the promoters and managements and investors mind meets. So these are again, as I've told you, how we kind of map the external environmental and assessment and opportunity mapping. Like, let's say today you are if you want to look at an opportunity, okay, let's say if any of my clientele is kind of fit to get a PE done. So this is the chart which I think which help you, which is called as opportunity mapping. What is their market? What is their product? What is their clientele? And is there is the innovation? So this is basically you're mapping the external environment in which the business operates, and once you identify the growth prospects and opportunity based on these industry trends and this market fit of your product portfolio, it will also evolve your customer needs and innovation. So if you see all this, so in this basic matrix, is your clientele's product or a clientele falling into it? If they are, I would highly recommend, please advise them to go for PE, and you be the main consultant or main guy to basically do that entire hand holding. This is the external environment analysis, and this is internal. Internal, as I've also discussed, what is the human capital, my operational excellence, value chain, and risk management. So if all these boxes get ticked, or not necessary that everything needs to be ticked, as I told you about the Paradise example of being a completely cash transaction, companies to handle cash in like big way, still they got a funding done. But at least you should be able to understand and you should be able to identify the problem. That is the most important thing. If you're blindfolded, then no one can then God help you. But if you know the problem, there should be a way you would like to kind of make a roadmap with respect to clearing the problems. How do you implement this strategic corporate interventions? So here, the best way is basically first I told you is identify. First, you have to identify what are the key areas of intervention is required by you for your client. You have to design the solution. Assign means identifying the leaders in your client's case who will be assigning it. Inform. You have to inform your stakeholders about the change. Like let's say you are doing this, you keep informing to the market that this is the, let's say your client has kind of upgraded into a new ERP. It's completely automated. You have to announce it after there's some positive news happening in the announcement should happen down the employees to your stakeholders and everywhere so that a positive story is created. How do you adopt it and how do you track it? So at the end, what value addition you're giving to the client? You're giving a competitive advantage, actionable business intelligence, operational efficiency, culture of compliance, and financial tangibility. So these are because all these mid-sized companies lack all of these, and you coming as a consultant kind of help your client to look into all these 4 to 5 structures. Well, thank you so much. I think I have kind of closed it up a bit early, 15 minutes. So yeah, thank you very much. And I hope this short session was useful and I could kind of help you guys to understand a bit.
Thank you, sir. And we have some questions. I'll share my screen, sir.
Please.
So is my Excel sheet visible? I'm sharing my screen.
Yeah. Hi. Can I go through it?
Yes, sir. You can read it out and you can.
Yeah. Perfect. Hi. The last 1-2 years, India has seen a huge growth in startups and growth. Will this trend continue for the coming years, or there might be a fall? Well, as you know, everything is going is like a circle. Right now, India is the biggest place for the startups. I mean, there's so much news with respect to startups and growth coming into the picture. The Indian story, the India story is really looking good. But as you know, it's like a circle. Now with your inflation, of course, rising, markets falling. Right now, to be honest, it has slowed down a bit now, but that effect will be probably coming down the line. So if you survive 22, 23, I think again from 24 things look better, to be very honest. For next 1 or 2 years, you might not see that huge growth. What we have seen from 2017-18, the valuations were mind-boggling. I mean, you can't even understand. We were getting, like as I told you, company making loss, getting so much of valuation was crazy. So right, probably 1 or 2 years you might see a slowdown, but of course it will fall again, get up. Okay, coming to the second question, do you think the mental health industry in India will pick up in coming? So if mental health with respect to, I mean, if I am not wrong, you're talking about, I think the behavioral pattern of the people and mental health with respect to that. Yes, of course, there are so many startups now in this which is called as your health tech sector, and health tech is very attractive with what do you call, with so many investments happening in health tech. It will of course pick up, and mental health is now being treated very seriously in our country. Earlier it was like if someone is going to a psychiatrist, people used to think is okay, what's wrong with him, but right now it's not. Probably yes, it is already picking up in an offline way, but in a health tech space that we need to see. Okay, what kind of financial instruments are acceptable for startup as SMEs can have a trading platform for business? What approach will be effective and useful, remain live unlisted and go for? Okay, so what kind of financial instrument acceptable? So basically, as I told you, the most common part is this convertible notes these days. Convertible note, all of you should read about it. Convertible note is one of the most attractive instruments for startup companies because all these companies come with a clawback clauses. So basically, based on the performance, let's say they're coming with a 51%, 26% stake. If you don't perform, promoters 5% stake will be taken by the private equity guys. So I think convertible note is the most accepted instrument, as SMEs can have a trading platform for both equity, what approach would be effective, useful, remain like and useful, remain unlisted, or to go for SME. Okay, your question is basically yes, SMEs can have a trading platform. There's a short term, there's a SME IPOs happening these days, of course with both debt and equity, which will be effective. It depends on what strategy they would like to follow. If they're okay for dilution, equity is good. If they're not okay, debt is good. So you have to do a cost benefit and analysis for them. And remaining unlisted or go to SME listing, on personal note, I think they should remain unlisted and look for a private equity guys to come into the picture. Okay, while doing valuation for startup companies, should we consider valuation based on the projected performance or keeping you the venture capital method? If you ask me, it should be both. And projected performance alone will not really help your cause. Also, the capital method of valuation is also important. I mean, that's what for me I'm trying to say. Any more questions?
Those were the questions that came up during the session, sir. And if there is any that comes up to us or mail, we'll share it to you or mail, sir. When time permits, you can respond it, sir. And
sure.
And some of them ask for the presentation, and if possible, you can share as a presentation. So,
yeah, there's certain few. I can't share the full one, but there are certain slides which I will definitely share it.
Yes, sir. The certain slide, the refined slide, you can share it to us as a PDF file. Also, we'll circulate to the registered participants alone. And
I'll do that.
Yes, sir.
I'll do that.
and one of our Rasim who have joined at the start, unable to join at the end, sir. On behalf of her, I'll propose vote of thanks. Thank you so much for your time spent here, sir, on this session. And in spite of having a sore throat, you have continuously spoke for nearly 2 hours and you have picked up all the questions. And thank you so much. On behalf of our chairman, secretary, and regional council members and office bearers in their absence, thank you so much for spending your time here, sir, on knowledge assessment.
Thank you so much. Thank you.
Looking forward to have you in person in Chennai, sir. Thank you.
For sure. Thank you so much.
Thank you.